Welcome to The Explainer. Today we're diving into something literally everyone has to deal with, and we are going to trace the entire arc of your financial life cycle. We'll start with the absolute fundamentals, the checking and savings accounts you interact with every single day, and we're going to travel all the way through to the highly strategic and, let's be honest, sometimes pretty complex world of end-of-life estate planning. So whether you are just setting up your first serious savings goal or you're trying to figure out how to safely pass on a lifetime of hard-earned wealth, this explainer is designed to give you clarity and, most importantly, control.
Here's our roadmap for today. First, mastering everyday banking. Second, growing wealth with CDs. Third, securing retirement with IRAs. Fourth, an introduction to AB trusts. And finally, smart asset allocation. Let's get right to it. Part 1. Mastering everyday banking. It's all about controlling your daily access.
You know, getting an account started online is actually incredibly simple these days, as long as you've got 4 basics ready to go. You're going to need your social security number, mostly for identity and tax verification, your current residential address, an email address you actually check, and of course, a way to make that opening deposit, like a debit card or a quick transfer. Line those 4 things up and boom, your account is up and running in a day or 2.
Now, here's a little secret. We all kind of assume midnight is the universal cutoff for a day's banking, right? Well, actually, scratch that. Behind the scenes, that 11:59 p.m. cutoff is entirely dictated by the time zone of the state where your account was originally opened. So if you opened your account in California, your cutoff is 11:59 p.m. Central Time. But in New York, it's 11:59 p.m. Eastern Time. And this matters so much more than you'd think. Any deposit you make after your specific cutoff won't count toward the balance used to pay your transactions that night. Honestly, understanding this quirky little time zone rule is absolutely crucial if you want to dodge those nasty, unexpected overdraft fees.
Okay, but what about the flip side? Just as important as opening an account is knowing how to close one properly. Leaving a ghost account floating around, that's just a recipe for surprise fees. So here is your definitive checklist to tie up those loose ends. First, update your contact info so you don't miss any final notices. Second, bring that balance to exactly 0. Cancel all your recurring payments. Yes, that means Netflix and your internet bill. Then, you've got to wait patiently for pending transactions to clear. Once they do, physically destroy those old debit cards and checks. And, this is a big one, download your final statements for your records. Because once that account is closed, poof, your online access is gone forever. Stick to this list and you'll leave with total peace of mind.
Moving on to Part 2, growing wealth. Let's break down CDs and how they help you control your future. Check out this number, $250,000. That is the maximum opening balance you can fund for a certificate of deposit when applying online. I mean, just imagine taking $250,000 and locking it into a guaranteed interest rate. It sounds great, right? But remember, when you open a CD, you are trading your immediate, everyday access to that cash in exchange for a reliable, fixed return. It's a trade-off, and because of that, you have to play completely by the bank's rules.
And let me tell you, those rules are incredibly strict when it comes to renewals. CDs are designed to auto-renew at maturity, so if you just sit back and do nothing, your money gets locked up all over again. Your only escape hatch here is what they call the grace period. For short-term CDs, we're talking 7 to 27 days, you have a razor-thin 1 calendar day grace period to make a move. For CDs of 28 days or longer, you get a 7 calendar day window. If you miss this window, no way out. Your money is committed for another full term.
So, what happens if you do miss that window? Or if life happens and you just need your money back early? Well, you're going to get hit with early withdrawal penalties, and they are no joke. Look at the stakes here. If your CD term is between 12 and 60 months, pulling out early costs you 180 days of earned interest. That's about 6 months. For terms over 5 years, you literally lose a full year of interest. In some crazy cases, if your account hasn't even earned enough interest to cover that penalty yet, the bank will literally deduct the difference straight from your principal balance. The big takeaway? Do not commit funds to a CD unless you are absolutely certain you won't need that cash until maturity.
All right, Part 3, securing retirement with IRAs. This is all about long-term wealth management.
When you're setting up an individual retirement account, or IRA, you are faced with a really high contrast choice. And it all boils down to one simple question. When do you want to pay the tax man? With a Roth IRA, you pay taxes on your money right now. That means your contributions aren't deductible today. But the massive, game-changing benefit is that your earnings grow entirely tax-free for your retirement. The traditional IRA? It's the exact mirror image. You get a nice tax deduction right now, but your earnings are tax-deferred, meaning you're going to have to pay taxes on those funds when you finally pull them out later.
Because of these tax implications, you really need to understand how to safely move money around, especially if you're rolling over an old 401k. The critical distinction here is between a direct and an indirect rollover. In a direct rollover, the money moves straight from institution to institution. No taxes withheld, totally clean, totally safe. But an indirect rollover, that is where the check is made payable directly to you. And by law, your former employer actually has to withhold 20% for taxes. Here's the massive trap. You have exactly 60 days to deposit the full original amount into a new IRA. That means you have to magically come up with that missing 20% out of your own pocket to finish the deposit. If you don't, the IRS treats that 20% as a taxable distribution, complete with early withdrawal penalties. Yikes!
Let's shift gears to Part 4, an introduction to AB trusts. This is how you control your ultimate legacy.
Now, to really understand why trusts are used the way they are today, we have to look back at history for a second. Decades ago, the estate tax exemption was just $600,000 per person. Anything above that, it could be taxed at a staggering 55% rate. Back then, trusts were basically an absolute necessity just to avoid financially ruining your heirs. But then, legislation shifted drastically between 2010 and 2012. The exemption got bumped to $5 million, and this concept called portability was introduced, which basically let a surviving spouse use their deceased partner's unused exemption. Fast forward to the modern era, and the exemption has soared to nearly $13 million per person, so the whole utility of a trust has completely shifted. For most of us, it's no longer just a middle-class tax dodge. It is entirely about having absolute ironclad control over your legacy.
And the core mechanism married couples use to maintain this control is called an A-B split. Here's how it works. When the first spouse passes away, their joint trust splits right down the middle into two. First, you have the A trust, often called the survivor's trust, which is for the living spouse. This one stays revocable and totally flexible to support their standard of living. Then you have the B trust, or bypass trust. This one holds the deceased spouse's share of the assets. And the absolutely key thing here is that the B trust immediately becomes irrevocable. Its rules are locked in stone. This guarantees that the deceased spouse's assets go exactly where they intended, whether that's to kids from a prior marriage or maybe a favored charity, all while still potentially throwing off some income to the surviving spouse.
Finally, Part 5, Smart Asset Allocation. Let's look at a scenario with our favorite family, The Simpsons.
Okay, legal jargon can get pretty dry, so let's see how this actually plays out in the real world using a hypothetical family we all know and love. Let's say Grandpa and Grandma Simpson worked hard their whole lives and amassed a combined asset pool of $4,005,000. This includes their house, some bank accounts, a brokerage, and an IRA. Sadly, Grandpa passes away. Now Grandma Simpson has to navigate this labyrinthine process of dividing their community property equitably between her flexible A trust and that rigid B trust we just talked about.
So how do you logically split a $4 million pie? Well, first, the survivor's A trust gets the $1.5 million house and $100,000 in cash. Because Grandma might want to sell the house or refinance later on, she really needs the flexibility that comes with this revocable trust. Next, the deceased B trust takes the $1.2 million brokerage account and $400,000 in cash. That perfectly matches the $1.6 million on the A side. Remember, this B trust is now completely irrevocable, which preserves the principal for their final heirs just like Grandpa wanted. And then, notice the third piece of the puzzle here, the direct assets. The $800,000 IRA and a small joint bank account bypass the trusts entirely. They go straight to Grandma as the named beneficiary. It really is an elegant, highly customized way to allocate a lifetime of wealth.
Of course, allocating assets in an AB trust requires meticulous planning and definitely consultation with some legal pros. But honestly, that's the big takeaway for this entire journey we've been on today. From double-checking the time zone of your everyday checking account, to sidestepping a brutal IRA rollover tax trap, to structuring a multi-million-dollar estate split, every single step requires active, intentional control on your part. So take a hard look at your own financial roadmap today. Are you just reacting to money as it comes in, or are you truly preparing your wealth for the future? Thanks so much for joining this explainer, and keep learning.